You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway listeners, I am so excited to introduce Paul Moore today. Paul has written a book talking about multifamily being the best investment, yet he doesn't invest in it. I'm excited to see why. See you in a minute. All right. Hello, everyone. Welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and I'm joined with a very esteemed guest today, Mr. Paul Moore. A little bit about Paul. After a stint at Ford Motor Company, Paul co-founded a staffing firm where he was a finalist for Michigan Entrepreneur of the Year for 2 years in a row. After selling this firm to a publicly traded company, Paul began investing in real estate, founded multiple investment and development companies, appeared on HGTV, and eventually built and co-managed a successful multifamily development. Paul co-hosts a podcast called How to Lose Money. He is also a contributor to Fox Business and Bigger Pockets, producing live video and blog content on a weekly basis. And Paul is also the author of a book called The Perfect Investment: Creating Enduring Wealth from the Historic Shift to Multifamily Housing and Storing Up Profits. I can't wait to get into this one. Paul is currently the managing director of 3 commercial real estate funds at Wellings Capital. Paul, welcome to the show. How are you doing today?
I'm doing great. It's great to be here. Thanks, Chad.
You know, I noticed at the end of your bio, and we kind of talked about this a little bit. I've got to confront you a little bit, man. You wrote a book talking about multifamily investment being the perfect investment, yet here you are running funds and investing elsewhere. What's up with that?
Hey, Chad, I got to run, man. No, I'm just kidding. So yeah, man, we after years of struggling through flipping houses and flipping waterfront lots and trying to do ground up development, big mistake for me. Did a subdivision, did all this other stuff. A lot of it worked really well. Some of it was really hard. But then I discovered large scale multifamily investing, 70, 80 units and up. And I was so enamored with the fact that the demographics are so strongly oriented this way. You've got millennials and baby boomers and Gen Z and immigrants all, renting more than ever. And you've got default rates incredibly low. You've got all these good things going your favor. So I thought, man, this is like the perfect investment. And that's what I told my wife. I said, hey, we're going to keep doing multifamily for the rest of my career. I'm 50. Let's see, at the time I was probably 52. So I'm like, okay, for 48 years, till I'm 100, we're going to plan to do multifamily. And so she's happy about that after I chased a bunch of shiny objects over the years. But honestly, I came to the conclusion, Chad, that the perfect investment is not perfect if you have to overpay to get it. And that's the situation that I felt we were in. I didn't have an acquisition team that really had the inside track on deals like you apparently do. And I didn't have, I didn't know brokers that were sending us off market or pre-market deals. And so I've concluded over the last 3 or 4 years that multifamily might not be at the best place right now. I feel like after reading Howard Marks' book, Mastering the Market Cycle, we might have been in a place where multifamily is really, really hard to get your hands on at a good price. And so we have expanded into self-storage and mobile home parks. And so that's where we're at as a company.
That's very interesting. And you are absolutely right, Paul. So there's kind of 2 strategies you can take here. One is like, hey, why do I get to the top with an acquisitions team who has the inside tracks? Well, because it's too crowded at the bottom, right? Everyone who doesn't have that is having a hard time and bidding my properties up, quite frankly. So you're absolutely right on that. And I'm glad you shine the light on that, because it is so much harder to find a multifamily acquisition with that intrinsic value, that allows you to build that equity. So
yes.
So what similarities did you find in these other 2 investments? Because they sound a little bit different. I mean, are there similarities? Do they have the same kind of economics and demographics behind them?
Yeah, well, I mean, so let's start with mobile home park investing. I don't know if you remember in the 90s, there was an ad campaign by the pork industry. They said, pork, it's the other white meat. I never really believed that. I don't know about you, but mobile home park investing is the other multifamily investing. I mean, it's an asset that has multiple families on it. And so like multifamily investing, we've got a whole bunch of people moving on to one property. But unlike multifamily, mobile home park investing typically includes the lease of land to these people, and then they bring their own home. So they've got the maintenance, the repair, the upkeep, all the hassle. In fact, the repair and maintenance budget for a mobile home park is actually really low if it's run right. It's about 1/5, I think, it actually of multifamily on average. And so that's one of the things I like about it. Another thing is, these tenants are really sticky. I mean, if you raise your rent on a multifamily, let's say 6%, and you're leasing it for $1,000 a month, well, they may leave rather than lock in for $60 more a month or $720 a year. But a mobile home park, the tenant, if let's just say you buy a mobile home park from a mom and pop operator and the lot rent's $300 a month and you raise it by 6%, that's what is that? $18 a month you're raising it by. They're typically not going to pick up their mobile home and go down the street and pay $400 a month. That doesn't even make sense because they have to pay $5,000 to move the home. And so the tenants are really sticky. One thing I really love about it is the opportunity to buy from mom and pop operators.
Yes.
Mom and pop operators. There's 44,000 or so mobile home parks in the US, and we believe 85 to 90% are owned and operated by small time operators. They don't have the knowledge, the desire, or the resources to increase income and maximize value. And in fact, Chad, they've benefited from the fact that cap rates have compressed from 10 or 12% down to 6 or 7 for them. And so they might have done nothing except operate a mediocre asset and not raise rents. And, maybe had seen the price, the value of their mobile home park almost double in the last decade. And so they're sitting quite well. We can pay them top dollar in their mind, let's say a 6.5% cap rate for this property. They can go on into retirement, but a great operator can do all kinds of things to help improve the community and raise the value of the property. Sometimes, like we saw a deal last year where it was doubled. The value of the property is literally doubled in a year. And with 50% debt, that means that equity was almost quadrupled, almost in 1 year. It's really hard to find deals like that right now. And so that's why we love mobile home park investing. Self-storage is similar. About 50% of the 54,000 or so self-storage facilities in the United States are run by mom and pop operators. And think about it. If you raise their rent 6%, let's say they're paying $100 a month for a unit and they're on a month-to-month lease. Well, you go up to $106. They're probably not going to spend a Saturday, rent a U-Haul, get their friends down there to move their their treasures to another unit down the street to save $6 a month, especially when most people think, hey, I'll be out of here next month anyway.
It makes a lot of sense. And so you said two things there I want to kind of highlight. One of them is talking about mom and pop operators, and no disrespect to them. They probably bought this for primary income and it's done what it needed to do for them, right? They're not buying it as an investment. They're buying it as income. Or maybe they came into it, or maybe they built it. I don't know. But what's beautiful about that is, let's come back to multifamily, because this is what I know. I don't know mobile home parks, but I'm sure this commonality is there. These big, shiny, pretty assets that come to market with these beautiful offering memorandums and drone videos and beautiful pictures, right? And have everyone and their mother looking at them and bidding it. and they're probably already owned by a fund or an experienced operator who's already raised rents quite a bit and done quite a bit of work and has positioned it for the next seller. That's going to get a ton of eyes. It's professionally marketed, it's professionally run, and you're going to overpay for it, right? Because of competition. Where, we do a similar thing on the multifamily side, where most of what we have bought has been sub 100 unit, where nobody wants to play because it's quote hard, right? It's not hard. You just have to do things differently, right? So that's what we do, is we go buy like 40 to 50 unit buildings that are typically owned by families or mom and pop. And it gives you that extra value because A, you can probably get it direct to seller, or B, you can get it where the financials are so far below where they need to be. Even if you do overpay, you have a ton of room there. So I love that you said that. The other thing I want to come back to you and ask you, you mentioned that cap rates at one point were at like a 12 or 13 or 11 or whatever, which kind of sounds like multifamily 20 years ago, right? But now they're running down at a 6 or 7. So are you seeing the same kind of effect of mobile home parks becoming popular and driving prices down, or what do you think is driving the economics behind that?
Yeah, the Sam Zell is arguably the most successful real estate investor in the U.S. or the world. And, he sold at some point around 2016, maybe, I think 23,000 apartment units. I'm guessing he's regretting that now a little since the value has gone up so much, but he did have an incredible run on those. He sold office, just in the nick of time in the past, a lot of office space, but he's acquired 157 or 158,000 mobile home park lots across, mobile home parks across the U.S. And, so he has really, and he and others like him have really professionalized a very fragmented industry. You've got banks now who are saying, hey, these loans we're making are incredibly safe, second only to self-storage, and just above multifamily, the loans on mobile home parks are doing very, very well. They rarely go into default. You've also got institutionals like Blackstone coming in and saying they want to buy not just mobile home parks, but portfolios of parks. And so there's a great opportunity. Think about it. You've got all these mom and pop operators, 85 to 90% of the parks. And then you've got a handful of institutionals. Well, what's in the middle? Well, the middle is professional operators who can take some, not all, but some of these parks from this level to this level, bundle them together, and then sell the whole package to an institutional. We just invested with a guy out of Denver. His team has done this before, and they're working on doing that again. And in fact, they did sell to Blackstone in 2019. And so that middle ground there is incredibly powerful. It's sort of what you're doing. You're not buying, fourplexes and eightplexes, but you're also not buying 300 unit apartment complexes, Chad. It sounds like you're right in that middle ground.
And I own about 9 of them within 2 miles. So it's the same kind of thing. Yeah. So it's the same thing. You just put them all together and now you've got scale,
Now you've got scale, and you can get a compressed cap rate when you go to sell to your institutional buyer.
What's brilliant about everything you've just said there, Paul, and you're kind of reassuring me here. So I'm glad to hear your experienced voice here. But basically what you've done is you said, look, I recognize what everyone's doing. And this is how people get wealthy, right? You don't follow the herd, you break against the stream and you go against the grain. But you saw what everyone else was doing, overpaying for these nice multifamily assets that were probably good deals 3 or 4 years ago, maybe 10 years ago. And they've already changed hands twice. So you said, I'm going to go to a different asset class where I can pick up something there's actually tangible value above what I'm paying for it, right? Not maxing it out. And you're trying to build wealth that way. So even if you maybe you said you're going to do multifamily the rest of your life, and then now you maybe think you're going to do mobile home parks the rest of your life. I bet here in about 5 or 6 years, you do this with another asset because mobile home parks will be too hot,
Yeah, it's absolutely true. We're already looking ahead at other asset types to add to our mix. And we still love multifamily as well.
Yeah.
But we're looking at residential assisted living at scale. We're looking at senior housing, at a decent scale, things like that. This may sound off topic, but hopefully it'll bring this home. It did for me, at least. Michelangelo was a great sculptor, And he said he could look at a piece of marble and see in the block of marble a beautiful work of art. All he needed to do was chip away the superfluous material to get to that beautiful sculpture that was inside. And I thought, that guy's weird. I thought, man, that's not true. And then I thought through and I thought, this is what a great operator does with mobile home park investing. They're not necessarily, or self-storage or multifamily. They're not necessarily adding value. They're extracting the inherent value. They're extracting what is they can see latent inside the asset that is not being extracted by the mom and pop operator. Here's a perfect example. We invested in Beeville, Texas, in a 607 unit self-storage facility. Now, as soon as the operator went in, first of all, he bought it from a mom and pop. These were kids who were fighting. Their parents had passed away. All 5 kids were angry. They were fighting. They were trying to get rid of it. And they sold this asset for $2.4 million. He had to move quickly to buy it because it was on the market for $5 million. He bought it for $2.4 cash. He went in and first of all, he added U-Haul. Now, we all know, you and I know at least, Chad, that with the value formula in commercial real estate, if you can add $3,000 or $4,000 a month to your bottom line by adding U-Haul, let's say it's $3,000 a month, that's $36,000 a year. Divide that by a cap rate of, say, 6%. You just added over $500,000 and sometimes approaching $1 million in value to the asset.
Right.
Well, that's a lot from signing a U-Haul agreement and setting some trucks outside, right? And so he also went in and improved marketing. He added a website. He slashed costs, and he filled occupancy that was basically, the occupancy might have been, let's just say it was 70%. Let's say he brought it up to 89%, which is kind of typical, 88, 89, 90. He increased rates. They were 25 or 30% below market. He just brought them up to market just by doing those changes. Get this. And he paid $2.4 million in March. And in July, he got, the end of June, he got an appraisal for $4.6 million.
Incredible.
At that point, he put debt on it for the first time of $2 million. That was only a 43% loan to value ratio. He had only $400,000 cash left in the deal. That was our cash and others. And when he sold for $4.6 million, a year later, that was a huge profit on a return on the equity, something like 400%, 500% return on equity.
That's beautiful.
That's the kind of deals you can get by recognizing the intrinsic value and paying the lower extrinsic value.
You know, there are very few opportunities like that in the space that I'm playing in, and a very similar story. Now, we haven't done it yet. We're closing on it in about 2 weeks, but we've actually been able to get our hands on a real estate owned property, which just means the bank has taken it away from whoever had it before. I'll spare you the details, but effectively the previous operator is in federal prison for fraud and lying to the government, right? So, but look at this. We have found now it's ugly right now. It looks like an army barracks. Okay. And it's in our industrial part of town, but it's next to a very affluent neighborhood with a little 3D rendering. You can actually see what this thing will look like once we reface the exterior and all that. But man, this is a 90s build. Wow. For 90s for 60 cents on the dollar in a market, right? Where like we're buying it around 43,000 a door. And once we're done with it in 12 months, we'll be able to sell it if we wanted to for 85, 90,000 a door. I mean, when you're talking about stuff like this, that's how people generate wealth. That is equity creation, not adding a couple of, not adding a marginal return and then trying to flip out of something, but massive equity creation, Yeah. So I love that.
So are you using debt on that, Chad?
I am. Yes.
So if you double the value of the property, you might be conceivably quadrupling the equity of the investors. Is that right?
That's true. That's true. Because, and the whole concept there, like you mentioned, is leverage. If we were acquiring it fully with our funds, that would be, maybe a 2x, right? As we mentioned on the cost per door. But yes, by using effectively 7% debt money, right? Which is bridge money, right? They're not expecting it to be performing. They're expecting us to do construction and put it back together. That's exactly what's going to happen.
That's really, really powerful. And I love that you were able to get your hands on that. And the power of what you're doing, Chad, is you're seeing the intrinsic value and you're paying the lower extrinsic value. Now,
that's right.
You can also go another step, as we talked about earlier, and that is if you can bundle a bunch of these together, you can even get a higher extrinsic value on the other side than the intrinsic value. In other words, you can go extrinsic buy, intrinsic improvement, and then even a higher extrinsic, in other words, the selling price. The power of what you did is almost impossible for individual passive investors to achieve. In other words, if I'm a doctor, a dentist, a lawyer, I've been reading Bigger Pockets for the last year, I went to a couple seminars, how in the world are they going to get their hands on that deal that you chase down through having the acquisition strategy that you have? They're not going to.
They're not. And you know why? Because my team and I, we did 25 million in acquisitions in the last 12 months. We are known. Like when something like this shows up, it is like, hey, let's call Quattro Capital, because we know the same thing with you guys and these mobile home park opportunities, right? You are a known buyer or at least a known investor in them, right? So you have more access to these kind of things, you know?
It's exactly right. It's the importance of having an obsession. Think about it. How many Olympic athletes are going to get a gold medal by being casual about it or having a full-time job and training on the side? It's not going to happen, or at least it would be incredibly rare. And I'd say it would also be incredibly rare for somebody who's passively investing or at least has a full-time gig to get a deal like that. And if they could, I virtually guarantee their family, their home life, and their health would suffer greatly as they tried to juggle being obsessed with two separate full-time professions.
That's right. For everyone who is a hobbyist, there is a full-time professional behind you who's going to beat you every time, right?
I absolutely agree. And I'm so glad we had this conversation because it kind of crystallized it even for me, Chad. And I'm really so amazed that you got that deal. If your listeners don't know this, I'm going to tell you, as somebody who's been investing in real estate for about 21 years, the deal that you just got or are closing on in 2 weeks is incredibly rare. Most of the listeners, if not all the listeners, including me, could go a whole lifetime without getting a deal like that.
That's right. And further, to kind of go a little bit beyond that, as you mentioned, let's say you did luck into one. Well, you don't bet on the horse, you bet on the jockey, right? Even if someone were to fall into something like this, knowing how to capitalize on something like this is a whole nother story, so it's very interesting.
True.
Well, Paul, we're coming to the end of the interview here. I want to ask a couple more questions, but one more thing, if you don't mind, on mobile home parks. Who do you get to operate these things? I mean, do you just go hire a property management company? Are there those out there, or do you actually need to invest in an operator, like someone like me, for example, who is going to run the day to day? I'm like, how does that operation look?
You asked me that earlier and I forgot to answer it. Basically, it is similar to multifamily, although there are only a handful of property managers, where there's probably hundreds and hundreds, if not a few thousand property managers in multifamily. There's only a handful in mobile home parks. There's quite a few more in self-storage. But yes, you can find one. You have to be at a minimum size level, though, just like you do with an apartment complex, to be able to afford them.
That makes a lot of sense. Perfect. Well, last two questions of the day, Paul. Thank you so much for being an amazing guest and adding so much intrinsic value to this conversation. So at Quattro, one of our 4 pillars and virtues is philanthropy. We love to give our listeners an opportunity to support the philanthropic causes that our guests are supporting. So would you mind talking about what philanthropies you're involved with and where our listeners might go to support?
Chad, I didn't know until kind of recently that if you took the record, not the average, the record profits from Apple, General Motors, Nike, and Starbucks, added those together, doubled that number, that would be the approximate annual revenues from human trafficking every year. It's a massive number. It's a horror. And even since we started this conversation, there have been over 100 people sold into slavery. And so I want to let listeners know that there is a way we can all help. My goal, my desire is to fight against human trafficking and rescue its victims. And there's a bunch of organizations who are doing a great job of that. One I'll point out today is called Exodus Cry. Exodus Cry is based in Sacramento, and they've done an amazing job getting governments to open their eyes to this, to exposing this industry, and to helping to rescue these victims.
Incredible. That will pull at your heartstrings. I wish the audience could see the double take I took when you brought that up, but that is a very real problem, and I had no idea the figures were that astounding. That is terrible. So definitely go support that one, y'all. That is a great cause. And Paul, I know you have a gift, I think, that you'd like to offer the audience. Where might they find that, and what is it?
Yeah, I mean, we talked about self-storage and mobile home parks today. I've got ebooks on those that are free, and also a commercial real estate investing kind of a 101 course that's all available at Wellings. That's Wellings. That's wellingscapital.com/resources.
Perfect. Fantastic. Well, Paul, thank you so much for being on the show today. I think we're going to have to invite you back if you don't mind. We'll talk about some other assets. That'll be good. All right. Well, this has been the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.